Silver didn't just go up, something snapped. In late January 2026, silver didn't grind higher or break out slowly. It vaulted past $116 an ounce, while gold cleared 5,100, and silver jumped more than 12% in a single session, about $12.50 in one day. That's the paradox. Prices are screaming strength, but the speed tells a different story, because moves that once took months are now happening in 24 hours, and that kind of velocity isn't normal. It's destabilizing. If you earn in dollars, save in dollars, or price your life in dollars, this matters to you. The data shows silver closed around $33 in May 2025 and more than tripled by January 2026. That isn't compounding, that's repricing. And it's happening so fast that what used to act like a ceiling has simply disappeared. But here's where the story flips. This isn't being described as a healthy bull market. It's being called a melt-up, driven by a flight from currency. And the next detail explains why this move may not be about silver at all. What's happening now looks like a price event, but it's actually a pattern event. The core move centers on precious metals, but only part of the information is visible at first glance. Silver trading above $116 and gold above $5,100 feels dramatic on its own, yet the framing matters more than the number. The material describes this as a decoupling from historic resistance levels. In plain terms, the market stopped respecting prices it used to obey, and that's rarely an isolated incident. This didn't emerge from a single headline or one bad data point. It unfolded as a sequence. Daily volatility accelerated. Moves that used to be considered wild became routine. Algorithms built for orderly markets started failing because the assumptions behind them no longer applied. When silver can rise over $10 in a day, the old playbook stops working. Now ask the reframing question. Is this really about metals becoming more valuable? Or is it about the unit they're priced in becoming less trusted? Because one of those stories ends with a top, the other ends with a reset. And here's the key tension. If this is a pattern, not an anomaly, then the first visible crack is never the most important one. The next signal tells you whether the system can absorb the shock or whether it's already losing control. Here's the claim that changes how you read the surge. This price action isn't being led by Western markets anymore. It's being pulled from the outside. The material shows a clear split. While silver trades around $112 to $116 in Western markets, the price in Shanghai has been recorded as high as $130 an ounce. In multiple instances, the premium reached roughly $15 over the Western price. That's not noise. That's arbitrage at a scale that drains supply. When one market is willing to pay materially more for the same ounce, metal moves fast. This matters because Shanghai isn't trading abstractions. It's bidding for physical silver. And that demand is strong enough that Chinese regulators stepped in, imposing immediate restrictions on silver trading, including limits on daily moves and new positions. Those controls aren't used when a market is calm. They're used when momentum is running ahead of authority. Notice what's missing. There's no indication this demand slowed after the restrictions. Historically, similar controls failed when physical shortages were involved. The implication is simple. Western paper prices are being forced to chase Eastern physical bids, not the other way around. But here's the part nobody says out loud. When price discovery moves east, control over pricing moves with it. And once that happens, paper mechanisms lose their grip. The next escalation shows what breaks first when that grip slips. Once price control starts slipping, escalation doesn't come from headlines. It comes from normalization. What would have sounded impossible months ago is now described casually. Silver moving $10 or $12 in a day is no longer treated as a shock. It's described as wild, but it keeps happening. The material frames this not as a standard bull market, but as a melt-up and disorderly rise driven by fear of currency, not confidence in growth. That distinction matters because melt-ups don't pause politely. There's a precedent here, and it isn't comforting. In past monetary stress events, the early phase always looked like momentum. Prices rose, commentators argued over fundamentals, and then the abnormal became routine. When something that shouldn't be normal becomes accepted, risk stops being priced correctly. Here's why that's dangerous. Containment mechanisms rely on disbelief. Resistance levels work because people expect them to. Once they fail repeatedly, expectations reset upward. The material notes there is now no technical resistance visible. That doesn't mean infinite upside. It means the brakes are gone. And when brakes disappear, acceleration isn't a choice. It's a consequence. This is where pressure shifts from markets to institutions. And that's where the real stress begins to surface. The next proof point isn't abstract. It shows up when institutions start stepping back. According to the material, major banks exposed to silver suddenly couldn't operate normally. TD Bank temporarily suspended sales of silver products. That's not a pricing decision. That's an inventory problem. And it matters because this bank had reportedly maintained short exposure to silver. When prices move violently against that position, the math turns unforgiving. If you've sold something you don't physically have and the price is exploding, your first problem isn't profit, it's delivery. At the same time, reports surface that the head of precious metals trading at Goldman Sachs is leaving the firm during this rally. The document is careful. It doesn't confirm whether this was a resignation or a forced exit. But timing is data. Senior traders don't step away quietly when everything is under control. Here's the contradiction that changes how you see it. Institutions publicly project stability, but privately reduce exposure. They stop selling, they stop making markets, they step aside. Notice what they didn't deny. There's no reassurance about inventory levels, no statement that supply is ample, no claim that volatility is contained. This is what a short squeeze looks like before it's named. And because silver is a relatively small market, even modest institutional retreat creates outsized price impact. When the sell side disappears, momentum doesn't slow, it accelerates, and the next layer explains where that momentum is coming from systemically. Behind the metal surge, another system is unraveling at the same time. For decades, global liquidity leaned on one quiet mechanism, the yen carry trade. Institutions borrowed Japanese yen at near zero rates and pushed that money into higher yield assets around the world. It worked because borrowing stayed cheap. The material shows that is no longer true. Japanese government bond yields are spiking across the curve. Short-term yields jumped from negative territory to over 0.7%. Two-year yields climbed above 1.2%. The 10-year reached roughly 2.4%, and the 30-year nearly hit 4%. That's not a tweak, that's a rupture. When borrowing costs rise that fast, positions have to be unwound, and unwinding means selling assets to repay yen-denominated debt. This is happening quickly, not gradually. Liquidity is being pulled out of bonds, equities, and risk assets at the same time. Now watch the pressure stack. Rising yields force liquidation. Liquidation weakens confidence in fiat assets. Capital looks for refuge, and instead of flowing into cash, it surges into hard assets that can't be printed. What happens if this continues? The carry trade doesn't unwind smoothly. It snaps, and when it snaps, it sends shockwaves through every market that depended on cheap leverage. The next part shows how that pressure concentrates into one specific metric that signals just how distorted things have become. At this point, it stops being a market story and starts becoming a personal one. Because when silver moves like this, it doesn't stay on trading screens. It bleeds into real life. The material shows retail dealers entering crisis mode. Coin shops are overwhelmed with people trying to sell. Some impose quotas, 100 ounces per customer. Others stop buying entirely, not because silver isn't valuable, but because they don't have the cash. That's the part most people don't expect. High prices are supposed to mean easy liquidity. Instead, the opposite is happening. Dealers report too much metal coming in and not enough money going out. Wholesalers and refineries aren't paying fast enough. Cash flow freezes. And suddenly, the place you assumed would always make a market doesn't. Put yourself there for a second. You own something the screen says is worth over $100 an ounce. You walk in to sell, and the answer is no, or worse, come back later. This removes ideology entirely. It's not about being bullish or bearish. It's about access. When liquidity vanishes, price becomes theoretical. If this feels familiar, if you've ever been told an asset was valuable until you tried to use it, say so in the comments, because the next layer explains why this keeps happening, even in systems designed to prevent it. What's happening here isn't chaos. It's mechanics. The system that prices silver was never designed for this kind of stress. It runs on leverage, speed, and confidence that most contracts will never demand physical delivery. That works when incentives align. It fails when fear replaces yield. The material shows exactly that shift. Futures markets still post prices, but physical demand is overriding them. When buyers don't care about premiums and sellers can't guarantee delivery, leverage stops working. This is the mechanism. Paper markets promise abundance. Physical markets enforce scarcity. As long as trust exists, paper dominates. Once trust erodes, the physical bid takes over and forces repricing upward. Not gradually, violently. Here's the unsettling insight. The system isn't broken by bad actors. It's breaking because it's doing what it was built to do: optimize efficiency over resilience. Just-in-time inventory, fractional reserve delivery, thin buffers. Those are features in calm times. They become liabilities under pressure. This is why mainstream coverage feels behind. They describe price, they miss structure, because structure only becomes visible when it's stressed. And now that stress is spreading forward in time. The next move isn't about what already happened. It's about what happens next if momentum doesn't slow. From here, the path splits, but neither option is calm. One path assumes stabilization. Prices cool, volatility compresses, institutions adapt. In that scenario, silver doesn't collapse. It plateaus at a much higher level, repriced permanently against currency that expanded too far, too fast. The system survives, but it's smaller, tighter, and less forgiving. Liquidity returns selectively, not universally. The other path assumes momentum feeds itself. Physical shortages persist, arbitrage gaps stay open. Paper markets keep chasing real demand. In that version, prices don't just rise, they gap. And each gap reinforces the belief that waiting is riskier than paying up. That's how melt-ups accelerate. Not because everyone agrees, but because no one wants to be last. The material doesn't claim certainty. It signals direction, the speed, the compression, the stress points lighting up at once. When multiple systems move together, probability replaces prediction. And here's the key detail. The next move won't announce itself with a headline. It will show up quietly in another delivery spike, another trading halt, another institution stepping aside. By the time it's obvious, it's already priced. And that leads to the final question, what this entire episode is really telling you. This wasn't a silver story, it was a measurement problem. When prices move this fast, the asset isn't changing. The unit is. The material keeps circling the same signal from different angles. Currency confidence is thinning, and markets are adjusting before policy does. Silver, gold, bonds, carry trades, they're all expressing the same stress in different languages. Here's the insight to hold on to. Systems don't fail all at once. They fail at the margins first. Inventory, liquidity, delivery, trust. What looks like volatility is often the system trying to reprice reality faster than people can process it. That's why this doesn't end with a number. It ends with awareness. Watching where pressure appears next tells you more than any chart ever will. If you want to stay ahead of that pressure before it shows up on your screen, follow for the next layer of this analysis, because this story isn't done unfolding.